Hi, this is Vema, your Austin realtor and land developer, here to talk about a 1031 exchange. A 1031 exchange is a way to swap one property for another property. Typically, when you do that, you're going to have to pay a capital gains tax. But with a 1031 exchange, if you follow the protocols, you can defer your taxes and pay the taxes later. So typically, if you were to have paid taxes, you typically pay a capital gains tax somewhere between 50 to 20%. But here, I'm going to outline how to use a 1031 exchange so that you can avoid paying that capital gains tax and defer your taxes to a much later point. So step number one, you have to, once the property closes, you have 45 days to identify 3 potential properties after that property has closed. And once after those 45 days, you only have 180 days to close on the new property that you're buying after you've sold the first one. And then you must do a 1031 exchange for a like-kind property. Now, like-kind, they're very liberal, so you can exchange a farm for a strip mall or raw land for even like a second vacation home. So they're very liberal on the choices of what like-kind means. So the great thing about 1031 exchanges is that you can do it multiple times and there's no limit. For example, you could buy a $100,000 piece of land, sell that, and then with the proceeds, use that money to buy a $200,000 piece of land. And then you could do a 1031 exchange to sell that and get to use the proceeds to buy a $300,000 piece of land. So that's the great thing about 1031 exchange. You can do it multiple times over in order to delay or what they call it, defer taxes to a later point. Let me give you an example of a 1031 exchange and how it might look. So let's say you sold a property January 1st of this year and you had a piece of land and you sold that property. You now have 45 days to identify 3 properties that you would like to buy with the proceeds from that land. So that's February 15th. You have to identify at least three pieces of property that you're thinking of doing the 1031 exchange for. Now, of those 3, you only have 180 days. So in this scenario, that would be June 30th to close on that piece of property in order to qualify for the 1031 exchange. And so that's the way like a 1031 exchange works. Something that's important to know is before you close on the property you're selling, you need to let the title company know that you're doing a 1031 exchange, because once you sell the property, if you receive the proceeds, you can't use that money then to do a 1031 exchange. Then you've accepted that you're paying capital gains tax. So the question you might be asking is what happens if 180 days goes by and you still haven't found a property? Well, then you have to pay the capital gains tax. Another aspect is what if you buy another property that isn't as much as the previous property? And so what that means is you use all the money that from the previous proceeds to buy the new property, and whatever is left over is known as boot, and that's the money that's left over, and that's going to be taxable income. So you have to pay capital gains tax on that. Well, that's all I have for you today. So please like and subscribe to my channel, as I'm going to have many more videos coming to you soon.